All right, welcome to The Explainer. Today, we're tackling a huge question. When it comes to building wealth, where should your money go? Real estate or the stock market? It's a massive decision, so let's break down where your hard-earned cash might work best for you. So let's just dive right in. Have you ever felt like the stock market is just one giant casino? You're not alone. It's a pretty common feeling, right? Prices shoot up, they crash down, and sometimes it feels totally disconnected from what a company is actually doing. You just put your money in and kind of hope for the best. And that right there, that feeling, is exactly what we're going to dig into. This quote just nails it. Real estate feels so tangible, so real. It can literally generate cold, hard cash every month. Stocks, on the other hand, can feel, well, a lot more abstract. So to really get to the bottom of this, you have to understand something crucial. These aren't just two different things to buy. They operate in completely different kinds of markets. And that one single difference, well, it changes everything. And this brings us to a really core economic idea, the difference between a perfect and an imperfect market. Now, I know it sounds a little like textbook jargon, but trust me, this one concept explains pretty much everything about where the opportunities lie in both real estate and stocks. So what does that actually mean? Well, think about it like this. In the stock market, pretty much everyone has access to the same public information about a company. The price reflects what everyone knows. But real estate? Oh, it's the complete opposite. Every single property is unique. The seller knows things the buyer doesn't, and vice versa. Information is not shared equally. Okay, so we've got these two totally different markets. The big question is, how does that actually affect your wallet? Well, the way you make money from each one is fundamentally different. And right off the bat, you can see a major difference here. Real estate gives you three distinct ways to get a return on your money, while stocks mainly give you two. But, and this is a big but, that extra potential you see in real estate, it comes with a trade-off. Okay, first up, the one everybody thinks at, appreciation. Simple, right? You buy a property, you hold on to it, and hopefully, over time, it's worth more than you paid for it. Straightforward. Then there's number two, cash flow. And this is a big one, especially if you want that feeling of tangible income. Your tenant pays rent, you pay your mortgage and other bills, and whatever's left over, that's cash, straight into your bank account every single month. All right, and the third one, now this is the one a lot of people sleep on, but it is super powerful, depreciation. So this is basically a tax break. The government lets you deduct for the building's supposed wear and tear, and get this, even if the property's value is actually going up. This can seriously lower your tax bill on that rental income, which means, you guessed it, more cash for you. Now, stocks are a little more straightforward, right? You've got growth, the share price goes up because the company is doing well. And then, some companies pay dividends. You can think of dividends as kind of like cash flow. The company's sharing a slice of its profits directly with you, the owner. Okay, so let's tie this all together. Let's circle back to that whole perfect versus imperfect market idea. How does that actually help you, as an investor, find a bargain? This is where it gets really good. That messy, unequal, imperfect nature of the real estate market, it's not a bug, it's a feature. It is where the opportunity to create some real value comes from. And this is how you get ahead in real estate. It is active work. You find a bargain because you know a neighborhood inside and out, or because you're willing to take on a property that needs some work. A leaky faucet or an ugly kitchen isn't a disaster. It's a discount. You are literally creating your own deal. Now, compare that to trying to find a bargain on a stock like Apple. Good luck, right? It's pretty much impossible. You've got millions of investors and professional analysts all staring at the exact same data. The price you see today already has all of that public knowledge baked right in. So this all boils down to one final and honestly a very personal question. How much work are you actually willing to do to make your money? Look, when you stack up all three of those return types, the appreciation, the cash flow, and those tax savings, aiming for a return of over 15% on a real estate deal is a totally reasonable target. Now, that can often smoke the average stock market return. But, there's always a but, it comes with a massive catch. And that catch is what we call the hassle factor. You know what I'm talking about. Tenants, toilets, and taxes. And even if you hire a property manager, guess what? You're still the one on the hook. It's a real investment of your time and your mental energy in a way that just owning a stock fund, well, it isn't even in the same league. So here it is, the fundamental trade-off, laid out side by side. With real estate, you've got a high potential to find a bargain, but it comes with a high hustle factor. With stock funds, the hassle is practically zero, but your chance of finding a secret deal to beat the market is, let's be honest, incredibly low. So at the end of the day, it's not about which investment is objectively better. It's about which one is better for you. Are you a hands-on bargain hunter who's ready to get your hands dirty? Or are you a hands-off long-term grower who just wants to set it and forget it? Answering that will tell you exactly where your money belongs.